So today, let's sort of center in on that last group, that ultra-wealthy group. And even at $5 million of wealth, you know, the estate tax is not going to be necessarily the conversation that's going to get them to do their planning. You know, what the American Society of CPAs tells us in their surveys with their clients is that clients with net worth north of $3.5 million are telling them, about 2/3 of them are telling them, we're going to wait till the estate tax law is settled before we do estate planning. Well, again, as you and I know, procrastination is the worst thing in planning, and we really need to motivate these clients to move. At the same time, those worth $5 million or more are just at the edge of whether or not they might be exposed to the estate tax. So let me introduce you to our clients here. This is our clients, Bob and Susan. They're both 68. They have a net worth of $7 million. And again, I can't really do a traditional estate analysis and say, hey, mom and dad, at your death in the future, this is what your family would owe in estate taxes. It could be anywhere from nothing to up to half of their $7 million plus whatever it appreciates to. We don't know. At the same time, this client has several young grandchildren. I would suggest to you that's their hot point in planning, is the grandchildren and how we can do planning for them. Really what they want to do is make sure that there's some security for their kids and their grandkids, but they really don't see any role for life insurance. If we shift that the plan is all about life insurance, it's going to be really difficult. What we're going to talk to them about is legacy planning and the role for life insurance inside of that. What they're really worried about is the future economic environment. Polling shows us that today, clients are the most pessimistic they've ever been about their children's economic future. Half of the American public, when they've been surveyed, has said they think their kids are going to be worse off than they are economically. Another 25% think they might be the same. Only 20% of the American public believes their kids are going to be better off than they are. That's the most negative polling we've had since it started in 1937, which was a recession year of the Great Depression. These clients are the same way. They're worried about the future, particularly for their grandkids. At the same time, they have no idea what the estate tax might impact them or how the changes were going to work. What they really say is, you know, we'd like to leave a meaningful legacy to our grandkids without a lot of risk to us. So one of the things we're going to suggest is they may take advantage of part of this $5 million gifting window that we have for the next 2 years. Certainly they're not going to gift away $5 million of their net worth. They may feel comfortable giving away $200,000 or $300,000, and they may do it in a couple of transfers, or they may do it over a number of years. Right now we have a 2-year window that we know for sure that they could transfer money without paying gift tax, but it would reduce the amount they can pass at death to the estate tax. And what we're suggesting to them here is that they transfer some money to structure into a $5 million second to die policy where we guarantee the death benefit. In our scenario, we're going to pay 20 years of premium. Now that may come from future gifts, or it may come from some current gifts that we place into the trust and that allow to be used later on for premium. One of their questions might be, you know, wait a minute, I don't know why I need life insurance. What happens if we don't even have an estate tax at the point that mom and dad have died? Why? We might not want the policy. Well, one of the things that we've kind of done in that, and that theme of flexibility is said, you know what? We'll give you your money back. And really with our second to die product today, we offer 2 windows where clients can get their premium back. One is in year 10, where they can get 90% of their premiums paid on a guaranteed basis. And another window is at year 15, where we will give them 100% of their premiums paid upon full surrender of the policy. So you know what? Hey, 15 years out in the planning window, there's no estate tax, and you don't believe you need insurance, and you think there's other better ways for the trust to use your money, we'll give it all back to you. 100% guaranteed, no questions asked. That's a pretty compelling argument for flexibility in your planning. You know, one of the things that we like about it is we don't charge for this. This is a part of every one of our survivorship policies that we issue. We don't have a cap on the face amount. So, you know, some carriers limit that the client can't get more than $5 million. We have no such limit on the cap amount. And also, we have no limit on underwriting or age. So we will take older clients on this, and we will take uninsurables on this. So again, the guarantees are available for those clients. Very attractive to offer them flexibility. But my argument would be, why would you ever surrender a policy once you qualify for it? And what part of my argument that I use for that is the internal rate of return report, which I've just flashed up here. I take you out to 25 years of life expectancy for the female, that's at age 93, be way beyond her current life expectancy. I still have a rate of return of the death benefit to the premiums paid of over 5%. Now, sometimes, you kind of hear, well, that's great. Insurance is great rate of return if you die early. But look at it all the way out at 25 years. It's just north of 5. And again, in today's interest rate environment, that's pretty attractive. But that's only part of the story. The other part of the story is that this policy is adding to asset diversification. At that second death, that might be a time when stock markets drop 40, 50%. Mexico and California and Canada have all gone bankrupt. The stock market swoons. Clients have seen major corrections in the stock market now. It's very fresh in their memory. So even though we've had a pretty good market run now, there is still this risk, this known risk by clients that they understand that what might happen to their assets and to their net worth with market conditions outside of their control. Here we've had asset diversification. No matter what's going on in that stock market, Transamerica is going to guarantee to send that family $5 million of income tax-free dollars to the family, to the family's trust upon the second death of this policy. Now, another question that might come up is, well, wait a minute, I want life insurance, but maybe I don't need $5 million. Maybe, again, if I was centered on the estate tax argument, I don't need as much coverage as I bought. Well, again, one of the things we've done in our flexibility is allow clients to reduce the death benefit after the 5th year without a surrender charge. Now, this applies for all policies in which at least we get $50,000 in minimum premium. After the 5th year, they can reduce the death benefit one time only without a surrender charge. We just don't hit them with a surrender charge on this. That is optional, though. They don't have to reduce the death benefit. In this case, what they've done is taken their $5 million policy, and in year 6, they reduced it down to $2.5 million, feeling that's adequate coverage at that time, and they reduced their annual premium from $105 to $42.8. But that's an option. They don't have to reduce that death benefit. Another thing that they might want to take in a little bit of planning scenario might be, well, you know what? I'm not sure if I want the policy owned by a trust. It may be that we want to own it, that we want to have access to cash values. Well, one of the things that we've done to protect clients in that kind of planning scenario is our estate protection rider. Now, we originally added this to our policies because oftentimes it took a while for the attorneys to draft a trust, and we wanted to allow clients to get the policy issued so we can protect their insurability, but we would allow them to add additional death benefit on their base face amount so that they add up to a year or so to get that policy issued and then get it transferred inside a trust. It can still be particularly attractive in this environment. Today, let's say that our clients applied for $2.5 million of insurance coverage at about $53,000 in annual premium, but they wanted to add our estate protection rider for the first 4 years up at $5 million. Their premium would go up about $241. That would be on an annual basis for every year up to the 20 years. But they would get that double coverage in this scenario up through 4 years. Now, it's important to note with this rider that in year 5, the death benefit does automatically decrease. It's not an option like it was in our previous rider. Here, it's going to automatically decrease. Lastly, one of the things they might want to consider is premium financing. A lot of people have thought premium financing is dead. It's not. It's still available. We have a concierge unit that offers premium financing, but the banks they work with all look for collateral. And, of course, the insurance is the #1 source of collateral. So one of the things we offer is our honeymoon provision, which allows a client to surrender their policy in any of the first 5 years for its accumulation value rather than its surrender value. Now, the reason that's important is for collateral purposes. That is can be used in a premium financing scenario and reduce their other collateral requirements. So very attractive from that basis. Premium financing is not dead. For certain clients, it may make a lot of sense. and if it does, oftentimes using the honeymoon provision allows them to reduce the lender-required collateral that they need for their policy by waiving that surrender charge during the first 5 years. So let's just summarize real quick what we've done by offering flexibility for this client. One of the things we've done is we've offered to give them their money back. So using our enhanced surrender value endorsement, we'll give them 90% of their cash values back in year 10. We'll give them 100% back in year 15. We don't restrict the death benefit amount on that, nor do we restrict the underwriting classification or age. They also are allowed to reduce their death benefit one time after the 5th policy year without a surrender charge. So again, gives them some flexibility. They need to pay at least a minimum of $50,000 in annual premium, and they do need to request that endorsement at the time of application, but they do not have to exercise it after the 5th policy year. That's fully flexible for them. The other thing we offer is the estate protection rider, which allows them to increase their death benefit up to 125% of the base coverage during the first 4 years of the policy's in force, within the mandatory face amount reduction in year 5. Lastly, the honeymoon provision, which allows them to use the accumulation values in lieu of cash surrender values if they were to surrender the policy any time during the 5th year. So you'll see really what we've tied together is a guaranteed product. We're going to guarantee the death benefit with a lot of flexibility. The flexibility of getting your money back, the flexibility of reducing your face amount, the flexibility of having additional death benefit in early years, and flexibility around an enhanced cash surrender value during the first 5 years. So kind of in summary here, what we really want you to think about is taking advantage of this 2-year window. Anytime the estate tax planning is in flux, you're going to get resistance to doing planning. I would turn that around. We're not really trying to just dealing with the tax. We're really dealing with your legacy here and how we can help you provide meaningful planning for kids and grandkids. And guess what? One of the engines that can drive that plan could be a guaranteed survivorship policy. And with Transamerica, there's a lot of flexibility in that policy so that you can shift some of your plans based upon the changing tax environment that we'll have in the future. So we're very excited about the environment that we're in today, and we think there's a lot of opportunities for us going forward. We would urge you to work with Pravada here to get illustrations, take a look at these policy designs, and see if we can really reach out to our clients and develop a meaningful legacy today.